Go. Hey everyone, welcome in to a daily editorial here on the KE Report. I'm chatting with Marc Chandler. We're going to be recapping the Fed rate cut this week, the reaction in markets, maybe even talk a little currency here, and then even more importantly, now look ahead to what else might drive markets. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which I will post a link to in the show notes. Marc, again, the Fed cut rates by 50 basis points. It was a coin flip between 25 to 50. They went with the larger one. Maybe you could say that they're playing a bit of catch up to some of the other central banks that already started cutting rates and already got a couple rate cuts in. A lot of people are saying, hey, the Fed should have cut last meeting. But again, now they did 50 basis points. I want to start off with the historical reference here, Marc, where there's a large contingent that say when rate cuts start, the markets actually roll over. I think we do need to analyze the state of the economy and why the Fed is cutting rates compared to some of the historical reasons. But what's your take on the rate cut? And again, these people saying that the markets might roll over because of these rate cuts.
Yeah, I think it's we often like confuse things about the just because something happens, like if A happens before B, it doesn't mean A caused B. And so I think that when we think about the how monetary policy works, the Federal Reserve is not responding necessarily so much to the way the economy is today, but how they think it's going to be, say, 3 or 6 months down the road. And I think that it seems to me that Powell is pretty clear, and so has been Fed Governor Waller, trying to explain that what happened was that we had the CPI number that we had seemed to have swayed them, seemed to have swayed the Fed, and that's why maybe that story was planted in the press about the risk of a 50 basis point move a few days before the FOMC meeting to help prepare the market for that. But I also think that there's a lot of if we're going to do something, try to do something very like statistically robust. We need to have a large sample size. And I'm just afraid that when we talk about how the stock market performs under different Fed cycles, I don't think we've had enough business cycles where the similar conditions really allow us to make it just gets too small of samples, too small of exception of like maybe it's too big of tails on these distributions. And so looking at averages and things like this, I just want to, I just think that sometimes looking at the big picture helps, sometimes it doesn't. I don't find it necessarily very helpful right now to think about how the stock market responded in the 1990 to Fed moves and how they'll respond today.
Well, we do need to consider that in the past, there have been rate cuts that have been emergency rate cuts, very different than it seems like this one that was predicted for 2+ years. But, Marc, what do you think about this 50 basis point cut? Did it catch the Fed up to other central banks that have already cut rates about 50 plus basis points?
I don't think that catching up is a good framing of the issue because it's not so much that these other countries are leading the Fed, so I'd consider more like a big S curve, and they're ahead of the Federal Reserve only in the sense of where they are in their own monetary easing cycle. So that we've seen already one G10 central bank, the Bank of Canada, cut rates 3 times, 75 basis points. In the coming week, the central banks of Sweden and Switzerland are also likely to cut rates another quarter of a point, and that'll be their third cut this year as well. And so other countries could be ahead of us in their cycle, but it's really where they are. And think about what's going to happen too. You know, part of the story is that the U.S. economy, where the U.S. economy is going, we've got a lot of momentum right now. You know, we were just talking about where the Atlanta and New York Fed GDP trackers are. I think they're close to 3%. And we've got one of the surprises of the week after the Fed's move was that the weekly jobless claims fell to their lowest level since May. And even if you look at the 4 week moving average to smooth out some of the volatility, we're at 3 month lows. And so I'm not so sure that catching up is a good way, but I do think that that what that framing does try to capture, I think, is that the big global monetary easing cycle has begun, and it began before the U.S. got involved. In fact, the U.S. is, I think, the seventh of the G10 central banks to cut rates.
I'm gonna carry this over to the markets then, because as we always seem to have is a bit of a counter move early on in those last couple hours of trading on Wednesday after the Fed statement and meeting and all that stuff. And then on Thursday, the trend that usually takes hold was everything green. I think the only things red on my screen were the VIX, so volatility, and bonds. Everything else was moving higher. What did you think of that reaction?
Yeah, you're right. Almost like textbook these days are very familiar in the past year and a half or so. I think this tells us a couple of things. One is the dangers of trying to time the market and short-term trading in the market and trying to look past short-term volatility and really stick to our knitting and try to be value investors as opposed to just momentum players. It's high risk around these types of events.
So are we in a risk on environment right now?
Yeah, isn't that the conclusion from there? Thinking about where we have a big monetary easing cycle, and what are they doing? They're adding liquidity in a way, like if you think about it like that, lower interest rates at a time when the economies looked like they were softening. And so I think that if demand is going to still weaken, then this has to go into financial assets, which is good for stocks and bonds and what we see in the currency market. So generally, the dollar has been under pressure.
So does the dollar continue to trend lower? Because I can help out a number of different sectors and emerging markets.
Yeah, I think if you look at what happens in a big, I don't want to oversimplify it, but if you look at these big cycles of interest rates and currencies, I think generally the dollar tends to fall during times when liquidity is being added, when there's a lot of easing of policy. And the world does better in many ways with a weaker dollar because many parts of the world have borrowed dollars and a weaker dollar lets them pay back those dollars with less domestic pressure.
What do you think about the balance sheet unwind as well? Everybody seems to be expecting that is going to stop, and some people are even expecting that they start expanding the balance sheet through some sort of a QE program. How do you see the roadmap?
Yeah, I think you're right. I think the Federal Reserve continuing QT, I think that surprises many. But I think they'll be able to do that through the end of this year, probably into early next year, before reserves are at levels that they think are ample.
So, Mark, what changes this whole outlook? It seems like we are going into another period of generally easier monetary policy, even when the U.S. economy is still pumping out some pretty decent numbers. China seems to be the biggest laggard out there. Europe's still struggling. There doesn't seem to be an economy that's absolutely crushing it, but the U.S. is doing okay. However, you've been on the show in the last couple weeks and even month or so saying that you are seeing weaker data. How does this all play into the bigger picture, monetary policy wise, and then filtered into financial markets?
Yeah, so people like myself have been thinking that the economy is slowing, but they're not quite in a recession yet. But I don't think that the Fed easing now really changes these larger dynamics. Not that it's too late. I just don't think that monetary policy alone addresses this. And part of the issue, I think, is when we really look at it, we say consumption is 70% of GDP. Well, it's true. It tends not to be so volatile. What tends to be more volatile is business investment. And that's where I think where the turn has come. So it's something to be paying attention to. But we'll have to see as we begin. I think Q3 is now just about behind us. It looks like it's been a strong quarter. We'll have to see what happens here in Q4.
What are you looking for moving forward then, outside of the election, which undoubtedly will cause some turmoil for the markets? What do you look for in terms of economic data that could actually shift policy, move either forward or back some of these projected rate cuts and impact markets?
I think that once again we've got like this tension between the Federal Reserve that just did those 50 basis point cuts before the end of the year and the market pricing in 75 basis points. And so ultimately, I think it comes down to the two jobs reports that the Fed gets. And I think that the weekly jobless claims that we were talking about and ahead of us. And so I think that markets might consolidate as even if it's in a broad trading range, and even if the high is not quite in place yet. I think ahead of that jobs report, but I think that jobs report is exceptionally important more important than the CPI or the personal consumption data.
So when it comes to market segments, any areas that you see as complete outperformers, winners in this bigger picture scenario, at least through the end of the year, maybe into next year?
I think what's happening, at least from a larger like international point of view, it looks to me like countries in East Asia they'll benefit from like the offshoring from China, and especially Malaysia and Indonesia have been doing very well. And I think that partly larger flow going on, which is if the Federal Reserve is going to be the Federal Reserve and other central banks now getting an easing cycle, getting entrenched. That this is good for risk assets. You have some issues in Latin America, partly the big ones are Brazil and Mexico. But I think the that's offshoring from China theme or meme, if you will, I think that is sort of taken hold and leading to some outperformance.
Does China turn it around at all in your eyes, Mark, or have they gone through kind of the growth, the historic growth that a small and then all of a sudden large economy goes through, and now we need to look to other countries outside of China as maybe the next up and coming economy?
Well, China, in some ways, like the United States, the sheer size, the scale is so daunting. And so I don't think we can ever like write China off. Even this year, China didn't meet its 5% growth target. There are people, economists projecting 4%. 4% is so bad. It's not like the economy is collapsing. It's really growth versus expectations. And remember, they have a shrinking population. But I think that we had a very interesting development in the last few days of the week where we saw the way China central bank sets the reference rate, the band of the central rate around which the dollar is allowed to move. There's usually very little change. And ahead of the weekend was a very large move, the largest move of the year. And this might be a policy signal that, in a sense, that they're getting ready to either make a policy signal or have allowed the currency to strengthen in case that they had some announcement that they thought would weaken it. So pushing it higher. So if it falls from a higher level, so it's not as significant. But I think keep an eye on that come Monday and see where the People's Bank of China fixes the dollar, sets its reference rate, and that I think is going to give us an indication that maybe there's a new policy move or initiative about to be announced from China.
Very interesting, Mark. We'll wrap it up here. I have another call coming up, another interview, but I always like getting your thoughts on what's happening within the markets and mostly the economic data and currency moves. This was a big week where the Fed has started its cycle of rate cuts and it started it off strong. Markets reacted strongly to it, but boy, oh boy, we'll see what the rest of the follow through is and what some of the upcoming economic data leads us to. Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which I will post a link to in the show notes. Mark, thank you for your time today. I really appreciate it.
Thank you. Good luck, everybody.